The Reserve Bank of India has released a draft framework for housing finance companies to seek public comments till July 15, 2020. The proposed changes seek more harmonization between NBFC and HFC regulations. For example, RBI wants to ensure the liquidity risk framework, liquidity coverage ratio, securitization norms currently applicable to non-banking finance companies are made applicable to HFCs. Double financing. RBI wants HFCs to only lend at one level, say either construction companies of a group or to individuals purchasing flats at those companies. This essentially means that HFCs should not lend to a realty developer and a home buyer seeking loan for the same project. At the group level, HFC's exposure in terms of lending and investment to real estate companies cannot exceed 15% of the owned funds in a single entity, while it is capped at 25% for all such group entities. Commercial real estate exposure also cannot exceed 20% of capital fund. Apart from that, the minimum capital requirement will be increased from 12% to 14% by March 31st, 2021. Qualifying assets. At least 50% of the net assets should be qualifying assets under the definition of housing finance for HFCs, excluding purposes not linked to the buying or selling or renovation of the residential units. For individuals, a 4-year timeline has been proposed with a 75% requirement for housing finance. Failure to meet these conditions will let the HFC being categorized as an NBFC, investment and credit companies. Also, to strengthen the capital base, existing home loan lenders will be required to double their minimum net own fund to Rs 20 crore in 2 years. Another important classification comes with systemically important and non-systemically important housing finance companies. If the HFC's asset size is less than Rs 500 crore, it will be classified as non-systemically important. The asset size of Rs 500 crore and above will classify the HFC as systemically important. The central bank wants big housing finance companies to be categorized as systemically important institutions. HFCs like HDFC, PNB Housing Finance, LIC Housing Finance, Canfin Homes and Sundaram Home Finance fall in the systemically important classification. Most of the big HFCs are already well regulated by the RBI and therefore the categorization might not make a big difference to them.